As of mid-August 2026, Tesla Inc. Nasdaq TSLA is changing hands at $342.27, carving out a tense recovery path above its short-term moving averages after enduring a brutal mid-summer correction that tested the psychological resolve of retail investors across Robinhood, Webull, and Reddit's most active trading forums. While financial media anchors obsess over fluctuating monthly delivery metrics and quarterly automotive gross margins, they are fundamentally mispricing the underlying structural reality of the enterprise. The modern market narrative treats Tesla as a cyclical car manufacturer experiencing a post-growth hangover in North American electric vehicle adoption. Yet the real engineering battleground has shifted away from the stamping press and the assembly line, straight into the thermal and computational bottlenecks of edge AI inference, custom silicon design, and distributed energy networking. Standard financial analysis completely misses the physical bottleneck, the massive power delivery networks and advanced semiconductor interconnects required to process multi-terabyte neural network streams in real time at the edge. While retail traders panic over a headline-grabbing dip in regional EV registrations, institutional algorithms are quietly modeling the capital expenditure required to secure high-bandwidth memory and custom-node foundry capacity for Tesla's next-generation autonomous fleets. The stock is not simply trading on how many Model Ys roll off the line in Austin or Shanghai. It is being priced as a high-stakes, capital-intensive infrastructure play, whose true value is bottlenecked by the physical limits of hardware compute, thermal dissipation, and the global scramble for high-end AI processors. This fundamental disconnect between public perception and physical engineering creates a persistent volatility trap where retail participants are routinely shaken out by macro jitters and algorithmic stop-loss hunting. Daily trading volumes regularly exceed 45 million shares, fueled by emotional retail swings responding to polarizing headlines about executive compensation packages, visionary product teases, and shifting sentiment from prominent market commentators. Beneath this frothy surface layer, institutional heavyweights, ranging from quantitative macro funds to long-term index architects, accumulate shares with clinical precision during sharp intraday pullbacks toward the $303 to $329 support zone. These sophisticated market participants are entirely unfazed by short-term compression in automotive operating income because they are underwriting a completely different financial thesis: the transition of Tesla from a hardware asset assembler into a monetized autonomous platform. When retail traders capitulate on a weak delivery month, institutional desks step in to absorb the float, recognizing that the long-term compounding value lies in software-attached gross margins and distributed energy storage networks. Where do you currently stand on this spectrum? Are you actively accumulating shares during these volatile dips, or are you sitting on the sidelines waiting for a definitive technical breakout above the $352 resistance ceiling? To understand why traditional valuation metrics fail to capture Tesla's true trajectory, one must deconstruct the company's operational segments through a modern lens that discards outdated consumer cyclical framing. Historically, Wall Street evaluated automakers based on unit sales, dealer networks, and capital expenditure efficiency relative to depreciating manufacturing plant equipment. Tesla has systematically obliterated that framework by decoupling its revenue growth from pure automotive unit cycles, pivoting aggressively into three distinct high-margin pillars: energy generation and storage, autonomous software as a service, and proprietary compute infrastructure. The energy storage division, anchored by massive deployments of megapacks across global utility grids, has transformed into a high-growth cash engine that offsets cyclical softness in passenger car deliveries. Simultaneously, the core automotive segment is no longer just selling a localized mode of transportation, it is deploying a fleet of millions of data-gathering nodes that continuously feed the company's neural networks with real-world driving telemetry. This creates a compounding data moat that legacy original equipment manufacturers cannot replicate because their vehicles lack the centralized compute architecture and over-the-air update infrastructure required to iterate autonomous algorithms at scale. When you look at Tesla today, you are looking at a vertically integrated energy and robotics conglomerate masquerading as an EV manufacturer. Looking toward the multi-year horizon, Tesla's valuation and market dominance will be dictated by its ability to navigate severe structural bottlenecks, geopolitical supply chain risks, and monumental capital allocation cycles. The primary catalysts ahead, including the commercial scaling of the Robotaxi fleet, the integration of humanoid robotics in industrial environments, and the deployment of advanced custom AI chips, require astronomical capital expenditures that test the patience of traditional equity analysts. The company is currently managing a multi-billion-dollar capex cycle aimed at securing next-generation foundry access and building out the sprawling data center compute clusters necessary to train its autonomous models. However, this aggressive expansion exposes Tesla to severe geopolitical risks, particularly regarding rare earth material sourcing, advanced semiconductor packaging constraints, and escalating trade friction between global superpowers that could disrupt critical supply chains. Despite these formidable hurdles, the definitive takeaway for the ambitious investor is that short-term price noise is an illusion designed to separate impatient capital from generational assets. By looking past quarterly delivery turbulence and focusing on the underlying engineering realities of autonomous compute and energy dominance, it becomes clear that Tesla is rewriting the rules of modern industrial scale. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.